The UK government is painting the picture that things are getting better. Inflation, cost of living crisis, all of that. But in this report, they suggest that in a few areas that really matter, that might not be the case. This is 160 pages of data from the OBR, or Office for Budget Responsibility, that accompanied our recent budget. Really, this is the substance behind those actions, and it's the data in this report that guides that policy. There's a lot of ground to cover here today, so let's just get on with it and start with the recession.
The UK will not now enter a technical recession.
When we're talking about recessions, what we're actually talking about is GDP, or gross domestic product. In a simple one-liner, that's the value of goods and services a country produces over a period of time, typically a year. A recession, well, not everyone agrees on what a recession is, but let's just say most people think it's when we have 2 negative quarters of GDP growth. So the value of stuff we make goes backwards for 6 months. Now, there is a whole load of political BS and positioning around this GDP number used to manipulate the perceived health of the economy that drives me wild. Can you tell? This is me, wild. Meow. GDP is expected to contract by 0.4% in the first quarter of 2023. Output then flatlines in the second quarter and starts rising again from the third quarter. So the OBR thinks we'll miss entering into a recession, as we won't have that 6 months of negative growth. So on paper, I mean, that sounds good, doesn't it? We might avoid a recession, GDP growth won't fall as much as expected 6 months ago, but I think when we look at these things, it's really useful to compare us to our peers, so we can see how the UK is keeping pace with other similar countries to us. I want to draw your attention first of all to 2 recent tweets directly from the Conservative Party and Jeremy Hunt, stating that the UK economy was the fastest growing in the G7 in 2022. I know that some people are going to say that I'm pushing a political agenda here, but I'm not. I think they're all useless, honestly. And if Labour were in charge and tweeting out things like this, I'd be calling them out for it as well. It is true that GDP in the UK grew the fastest in the G7, but how do I explain this? Have you ever heard of newbie gains in the gym?
Show what mighty muscle can achieve.
The rapid increase in muscle and strength that often occurs when people with little to no previous weightlifting experience start training intensively. The weaker you are, the quicker you can grow. Now, Britain isn't bench pressing, but we have grown the fastest because we decline the most. This graph shows that nicely. The green bar here is the decline, showing just how far the UK dipped versus our peers, and makes the growth here look less impressive compared to those peers. The UK is the only G7 economy which is still smaller than it was before the pandemic. We're down about 0.8% overall. This sort of positioning is a little misleading when you consider the whole picture. I just wanted to point that out. Right, so the obvious question is, why are we the worst performer overall? The report pins 3 main reasons for what it calls structural weaknesses. A lack of investment from business since Brexit, due to the uncertainty around how we will trade with Europe. The labour market participation numbers, as in the amount of people who have not returned to work since the pandemic. And then a decline in overall productivity. The productivity point kind of makes us all sound lazy, doesn't it? But anyway, business investment as a result of Brexit and a decline in labour participation rates are really why we've just seen the budget we have. Measures around pensions and childcare are aimed at getting more people back into work, and the incentives for businesses around taxation are an attempt by the UK government to make the UK look more attractive for businesses to invest here. So you can see really how policy is being guided by performance and by the numbers in this report. So if GDP is the big picture, what I want to now do is zoom in to a metric that is a little bit more reflective of individual living standards. Real Household Disposable Income, or RHDI. RHDI speaks directly to our quality of life as individuals, and I think it's probably one of the more meaningful data points we can use to see how well things are going at a home level. Household disposable income is what you have left after you take taxes away. Real household disposable income is the same figure but adjusted for inflation. RHDI is expected to fall by a total of 5.7% over the 2 financial years 22-23 and 23-24, by 2.6% in 2023, following a fall of 2.5% in 2022. While this is 1.4% less than the forecast in November, it would still be the largest 2-year fall since records began in 1956. The first thing I want to point out here is that the fall over the coming year is actually predicted to be bigger than the one we've just seen in the last year. So even with this upbeat tone and talk of all this wiggle room for Jeremy, the thing that matters, as in how much money we all have to spend on things, is still set to go backwards by more than it did last year. The report states that living standards will still be below pre-pandemic levels in 27-28 by 0.4%, even though this is an improvement on the forecast from November, which had it at 1% lower. Again, let's compare this to the G7. This graph from the OECD looks at disposable income from Q1 2021 to Q3 22 and shows that really only Canada has had it as rough as we have. What's that about? Quite a grim outlook from household disposable income, isn't it? Now, while I'm always going to say it as I see it, I also want to be optimistic and for this to be a happy place for people to come and discuss their finances. There's enough doomsday merchants on this platform for everyone to watch if they want. So I want to kind of be the opposite. And I just want to point out that in just 6 months, these guys have halved the number in terms of expected decline in real household disposable income. The whole report really is them just saying, we've downgraded our estimates as things have improved. If it can change that much in 6 months, anything can happen in 4 years. Okay, now I want to look at inflation.
Inflatable 5.
Someone asked me the other day, can you please explain how this lot think inflation will hit 3% by the end of the year? I don't need to. The report does it for us. The sharp fall occurs as the rapid price increases in 2022 drop out of the calculation of annual inflation. We need to remember that inflation, much like our investment returns, when we have any, is compounding. The rate of growth in prices is measured yearly on top of the previous year's growth. The problem with the way the media and politicians portray inflation is that it makes people think that if inflation rates come down, prices fall. They don't. They're still going up, and when we've had massive spikes in inflation in one year, it's almost to be expected that the next year's would be lower in comparison. I guess it's like sort of a reverse of the whole newbie GDP growth gains at the start. This is why I have such an issue with the victory parade politicians go on when inflation falls, and the phrase, we want to bring inflation down to help with the cost of living crisis. Prices are still increasing, and we've just seen with the RHDI data in the previous section, the OBR thinks households will get poorer this coming year than they did last year. If that's the case, then the cost of living crisis is getting worse. We would actually need a period of deflation to see prices fall to help with the cost of living crisis. The OBR forecasted we would have a period like that, but now they've changed their minds. I mean, what a difference 6 months can make, eh? Notice here the November forecast is the dotted line, and it went under zero, a period of deflation for prices. Deflation in prices can actually be a really bad thing. If prices are falling, people stop buying as they're waiting for prices to drop further, so prices keep falling because there's no demand. People then get sacked, meaning people have less money to spend, and the problem just keeps getting worse. We have a negative spiral downwards. Now, the March forecast actually thinks inflation will hit the 0% range just after 2025, which would hopefully then allow people's incomes to catch up, and that would help people with the cost of living crisis. Okay, now let's look at participation rates in the UK workforce. This was a key focus for the budget, and it's really interesting when we look at the data. When I say something's really interesting, it makes it sound like it's going to be super boring, doesn't it? More people who could be working are not working. Around 800,000 people, they think. 310,000 of those are baby boomers. This generation is retiring, and they're a large part of the workforce, but we knew that was coming. The bigger concern is this 500,000 or so other people who, since the pandemic, have just stepped out of the workforce and are not really returning. Now, the OBR reports on the reasons for this. The colours here represent the reason for not working. You can see them up here. Being sick is a huge part of the problem. And we're actually seeing the amount of people off work due to illness rising even after the pandemic has ended. Also, the amount of people reporting they're off work due to caring for family, that's falling. So that might make you question why measures have been focused at childcare when really the issue appears to be more around long-term sickness. I guess that's a harder problem to fix. There are points in the budget around helping disabled people get back into work. Before we get into that though, I also just want to talk about the student bit here. You see these yellow bars? It's always been a big chunk of the people who could work who don't. They're just studying instead. But I'm just thinking out loud here. Maybe measures targeted at apprenticeships and getting people straight into work at the age of 16 would be a good idea. After I started my first job, no one ever asked about my degree again. But I felt that I had to get the degree in order to get the job. Again, just personal experience. But if I feel this way, some other people must as well. And given my time again, if someone said to me at 18 or even 16, don't bother with A-levels, don't do a degree, here's an apprenticeship that will get you into the finance industry and you'll learn from day one and learn skills on the job, I'd have probably taken that. I don't know what exists for younger people to get into work, but with all of the businesses that I worked for in finances, Degrees were used as a screening process for applications. It was literally just like a box tick exercise where we filter through applications by going, have they got a 2-1 degree? Yes, okay, they can move on to the next stage. 3 years of my life and 20k plus a debt just to jump that tiny little hurdle. Maybe that needs to change. Now, it's unclear to me from this data if the same people who were reporting that they were looking after family are now saying they're sick, or if they've returned to work and the amount of people reporting sickness has increased. The report states, the group reporting to be sick or disabled has increased by 350,000 people to 2.5 million in the fourth quarter of 2022, and now accounts for 28% of the total number of working age inactive people, and about 6% of the total working age population. I said in my reaction to the budget, I didn't know enough about the system that exists in this country to help disabled or poorly people get back into work. There were reforms in the budget that seemed to target this, but feedback from the comments, which I welcomed from those who kind of are in the know, was critical of the reforms and their effectiveness to help people get back into work. All I can say is there is a growing trend here of people stepping out of the workforce due to illness or disability, and it looks like there's been a surge since COVID. Why is that? Is it long COVID? I don't know. I guess another key question is this a temporary trend or is it more persistent? Okay, now let's look at property. There's 2 questions I want to answer here. How high will interest rates go? So mortgage costs as well. And how far will house prices fall as a result of that? Now, house prices have fallen. The feeling on the street is pretty much confirmed now. The OBR says that the best indicators peg the decline at somewhere between 3 and 6% so far. We now know that Q4 2022 was the peak of the market, and the OBR thinks prices will fall 10% overall from the peak. This graph is very crude, but it looks like they're saying that the bottom of the market will be about Q2 2024. The thing about property and prices of property is that it's largely driven by sentiment, as in how people feel about the market. That means that forecasts like this can be self-fulfilling prophecies. As everyone expects house prices to fall, they stop buying and sit on the sidelines. And then when Q2 2024 rolls around, they think, right, bottom of the market, jump in. That causes a surge short term. Everyone on the sideline then goes, oh snap, it's happening.
Okay, it's happening. Everybody stay calm. What's the procedure, everyone? What's the procedure? Stay calm.
Then off we go again, bring on the next bubble. Now, it's also true to say that property as a section of the economy is the slowest to move. It isn't like the stock market where every time there's a scrap of bad news hits the headlines, the whole thing hits the bed and drops like a stone. House transactions take time to go through, and mortgages have fixed periods on them which shelter people from interest rate rises. If the economy was one of those bendy buses things, then property would be right at the back here, and we would see it go around the corner last. With more than 80% of mortgages on fixed-term contracts, and with fixed terms of more than 2 years having risen, the increase in rates on new mortgages over recent months will take several years to feed through to the average mortgage rate. It's going to take years for the rise in interest rates to be reflected in everyone's mortgages. People who think the market is going to tank will say that this is the thing on the horizon that will sink the market. Others might say that the drip-feeding impact to rates, people coming to the market over time that can't afford it, will mean we won't see this glut of motivated sellers flood to the market that you normally need when we see property prices crash. With regards to interest rates, average interest rates on stock of outstanding mortgages are expected to peak at 4.2% by 2027. Because the outlook is more positive, the OBR expects interest rates to go up less. This grey line is that revised estimate and is almost 1% lower than just 6 months ago, which is a massive adjustment in expectations and should hopefully provide some comfort to those of you with mortgages. But the key takeaway from this graph is that rates are expected to stay high compared to really low rates of the last 10 years. The graph goes to 2028 and is at 4% all the way. 4% is actually far more in line with the average long-term rate. The average rate over the last 50 years is 7%. Even with this period of record low rates. I've linked the full reports below for you as I've missed out loads of detail here to focus on the key bits. I hope you appreciate I can't go through everything covered in the report because it's just so big. They cover every aspect of the economy in detail. I mean, it's 160 pages after all, so yeah, link below for you. But I think it is clear from the report and from the comparisons we've done with the G7 that the UK has been the worst performing economy out of the lot and continues to face some serious headwinds. But the overall tone of the report is far more upbeat than 6 months ago, with most of the grim predictions being slashed in half, which kind of makes you question how much should we be listening to this anyway then, if what they're forecasting years out is being changed every 6 months. I look forward to dissecting the next one and seeing if they revise their guesstimates again, but in the meantime, you need to watch this video here, where I look at economic forecasts and why they're so unreliable. And I use the medium of snooker balls and a brand new dent in my floor. Thank you.